Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Edward Hertzman. He's the founder and president of Sourcing Journal. We're going to take a look at apparel manufacturers and their exposure to tariffs and how corporate management is handling what's at task with them. Thank you so much, Edward, for joining us at Market Site. And apparel and footwear manufacturers, it's going to be pretty difficult for them if these tariffs really do go into effect.
Oh, absolutely. I mean, the reality is you're looking at 30 to 40% of apparel coming out of China right now, with 60 to 70% of footwear coming out of China. And the ability for any retailer or brand to move is much more difficult than I think anyone imagines. Even if you go to Vietnam, which has less than 100 million people living there, they do not have the capacity. So as you move to Vietnam, you move to Cambodia, you move to Bangladesh or Pakistan, they just don't have the global capacity in order to accommodate the orders. And what we're going to see is inflation happening through the supply chain. So even though we have a 25% potential increase in China, it's not like we're going to just see these other countries staying flat. They're going to increase their prices because there's going to be more demand than supply.
Of course. Well, and that's the whole thing too. What happens to store closures and so forth? I mean, it's going to get impacted somewhere.
We're going to see it's going to get a lot worse than I think a lot of people want to talk about. First off, you're going to see anywhere from a 15 to 25% increase in apparel price. What a lot of people are trying to do in the short term is, in anticipation of this, is air in goods before Labor Day to hopefully, mitigate some risks for back to school and fourth quarter. But the other thing is, for the past 3 years, we've been chasing, instead of chasing the cheapest price, we've been chasing instead of chasing the cheapest needle, we've been chasing the smartest needle. And we've been trying to reduce inventory levels. And by doing that, we've been taking in less inventory, we've been able to replenish quicker, and that helps margin. By moving to some of these longer lead time countries, what's happening is we're going back into a very archaic model. So if we go to Bangladesh and some of these other countries and we go back to a 6-month lead time, we're going to expose ourselves to a whole other slew of problems, which no one is really talking about right now.
Well, didn't this happen 3 or 4 winters ago when it was really warm? It was like 50, 60 degrees on Christmas, and they were stuck with all of this inventory that they couldn't get rid of. So you can't have a variable like that if you go back to this old model.
Absolutely. I mean, that was a one-off instance where getting stuck with a lot of inventory is deadly. I mean, the off-price channels really are able to take advantage of that, which is why, whether you're in a strong economy or weak economy, the off-price and the discounters always tend to do well.
Yep, they certainly do. Now, let's talk about that when it comes to guidance and corporate management. It's got to be really hard to give even a quarter, 2-quarter outlook. You just never know. The pace of the rhetoric is just too quick.
I'm going to be frank. I think that, look, the street has to remain somewhat optimistic.
Right.
No one wants to really speak how bad this could really be for their companies. First of all, we really don't know, if this is even going to happen. And to say, oh, I'm going to reduce costs, I'm going to try to pass it on to the factories, or I'm going to move countries. We all know that at the end of the day, you cannot make up 25% margin. So the question is, how do you split that pain across, 5 or 6, variables throughout the supply chain? Could a little bit happen at the fabric stage? Could a little bit happen in the factory, at the agent? Can the wholesaler, work on a little tighter margins? Can the retailer? But ultimately, you cannot absorb that type of cost, which means the customer is going to pay the ultimate price.
Right, they certainly will. And we're actually seeing that with some of the semiconductor earnings that have been coming out, where the larger consumers of the supply chain, if they're not reporting well, you're seeing it trickle all the way down. So it kind of is happening in real time.
Oh, absolutely. And I think that, there's various projections that are out there. Some people are saying we could see anywhere from 2,000 jobs lost. We could see the average households of losing or having to spend 2,000 more on consumer products. Family of 4 having to spend 2,000 more. So the question is, on discretionary items like clothing, this is going to be impacted even quicker.
Right. It's almost like, is this $250 billion tariff? Is it worth it? I mean, I know for security reasons and so forth, there are more bargaining chips at the table.
If this tranche 4 happens, and I think now it's up to what, 300 million?
325, yeah.
From my perspective, which is really, I'm looking at the apparel and footwear space, it's a disaster. I mean, this is already an industry that has a lot of issues. And I mean, we just have to look at the stock prices over the past year. So you have internet, which is playing a big play in this. Amazon's taking over a lot of market share. There's a lot of added logistics costs that no one is really considering as you move to a more DTC model. there's so much variables that are happening. The industry doesn't need this right now.
Right.
And the margins are already so tight, we can't make up for this. So it's creating panic, it's creating uncertainty. And if this does happen, you're going to see an accelerated bankruptcies and accelerated store closures.
Yeah, and it's like you were saying before about logistics. You can't just close a factory in China and open a new one in Bangladesh. You can't turn a ship around that quickly.
No, I mean, first of all, if you look at footwear, right, there's a lot of CapEx investment. There's a lot of, the labor force has to be quite skilled. And so that's an industry which is very difficult to move. And if you're talking about, as I said earlier, 60 or 70% of the footwear coming out of that country, there's only a few places you can go. Maybe Vietnam, maybe Portugal, maybe Italy on the high end, maybe Mexico, but they make up very small percentage points. If you look at apparel, again, we could shift some production. China is still going to be very important for maybe value-added products, more of the technical performance type wear. But ultimately, what I'm more concerned about is even if you save a few cents or a few dollars here or there, it's going back to this old model. I think that we really have to think about you're not making money by sourcing the cheapest product. You're making money by selling through it at a higher margin, by being able to replenish quicker. China offers that advantage. Moving out of China to these other countries, it's going to create a lot of complexities to the supply chain.
Well, I appreciate that insight, and we always kind of want to hear the bullish side of the story. But the fact of the matter is, it's refreshing. You have to take a look at this because it makes a difference.
I've always been quite bearish on the state of affairs, and I think this is going to be quite challenging for a lot of people.
Well, we'll see how it plays out, and we'll certainly have you back to follow up. Thank you so much for joining us.
All right, thank you.
And thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.